Okay, everybody, going to go over our Forex trades for today, Thursday, October 1st. Four trades on a size-adjusted basis pulled out 16.8 pips. We'll go over that in a minute. First, just want to touch base on some economic numbers that came out this morning. Initial jobless claims, worse than expected, but it's a weekly number, so you don't put too much weight in that. U.S. manufacturing PMI came in pretty much in line, although the employment index of that fell to 50.8 from 52.4, the lowest reading since June of 2013. The head of that department came out and said we must remember manufacturing sector only accounts for around 10% of the U.S. economy. I kind of giggled a little bit. Sadly, manufacturing is only 10%. I thought it was closer to 20%, but I guess I'm wrong. I would think that they would know what they're talking about. But you would think the politicians would figure a way to get some jobs going in this country, figure a way to bring back manufacturing. I, for one, I can't stand products made in China. Products made in Japan, South Korea, a little different ball game. They're higher quality. The stuff in China is just horrible. If I have a choice of buying two things and one's in China, one's made in China, one's made in America, I know I'll pay more for the American one, but I'd rather pay more and get better quality. It's most likely less likely that it's going to break. I find myself when I buy things from China, they're made cheaply. They end up breaking. I end up buying two of them, maybe three of them before I learn my lesson. I could just buy the one from America and spend a little bit more money, but over time it's going to cost less. At least has been my experience. Like I said, stuff from Japan, South Korea is definitely a different quality. Not that that's a reason to keep the jobs there, but this whole thing about China, it's great because you can manufacture everything so cheap. Yeah, maybe you can, but bottom line is the quality is just not there. I wish more people would kind of take my view and start buying American-made products. If you can't afford it, don't buy it. You don't need to have it, right? Anyway, that's going down a whole other thing. What else came out this morning? So the ISM manufacturing, that was the weakest since May of 2013. Some of the respondents in the survey, they said overall business is slowing, consumers are nervous, and they're not sure what's coming next. That harbors right back to the market. The market's been getting beat up lately. Let's throw away that the unemployment numbers are extremely high, nowhere near what the government says, and probably closer to 20%. Let's take that out of the equation. Let's talk about the people that are working. They're nervous. They're nervous they may not have a job. They're nervous they might let go because the economy is slow. They know the economy is slow, and now the Wall Street is recognizing that the economy is slow. Not that they didn't know. I don't want to say that, but stocks are getting beat up. As it was a few weeks ago, the head of the National Association for Realtors comes out and said that a weak stock market would be good for housing. I mean, that was absolutely absurd. We all know that's absurd. He's either delusional, stupid, or just sees things from a completely different perspective. Obviously, I hope it's the last. I hope he's not delusional from taking drugs or anything. I hope he's not stupid. I mean, I doubt he's stupid. He's the head of the National Association of Realtors. But to make that statement, you have to question how do you make that type of statement? We all know the higher stock market goes, the more money people have. Over 50% of the people in America are in the stock market in some form or fashion. And that's down. It's 50. I think the number is 52%. That's down from a high of about 66 or 67% before 9/11, when things were crazy during the tech boom. We all know that when the economy's good, when the stock market's solid, housing, it's going to go up. But we've been saying housing's not going to go up. We've been saying we're ready for a downturn in housing right now. Hedge funds have stopped buying. Not all of them, but the largest hedge fund that allocated $8 billion towards real estate has stopped. They stopped 4, 5, 6 months ago. Others have stopped, and not that they're selling, but they've stopped. There are some still buying, but you have that, and now you have the Chinese, it was 80% of houses in San Bernardino, I believe it is, California. 80% were purchased by Chinese. That's kaput. That is ended. Over. The economy in China is collapsing. Their stock market's collapsing. Money is not going to flow into LA, Miami, New York from the Chinese. And all this real estate, it's all going to sag. In other sectors of the country, you know, where the real estate is not as volatile, we'll probably see a slowdown and a correction. But in the markets that have been hot, Miami, New York, San Francisco, LA, we're going to see a good correction. How deep and how far, I don't know. I doubt it'll be like in 2007 and 8 in housing, but it's coming. I know it's coming. What else? Oh, the head of the ISM, his name is Holcomb. He said he's hopeful manufacturing is nearing a bottom. He's another Einstein. This guy. How could you be hopeful it's nearing a bottom? Are you not looking at the economy? Are you not looking at the global economy in Europe, in China, in Japan, in America? Are you not looking at that in Australia? The global economy is cratering. China is getting decimated. Our economy is nowhere near as rosy as the government says, and it's even slowing now. And this guy is saying he's hope manufacturing nearing a bottom. How could manufacturing be nearing a bottom? First of all, we only have 10% of our people that work in the economy are in manufacturing, and that's slowing. It's going to slow even more. And I'll tell you why I'm so positive about it. Goldman Sachs on Tuesday lowered GDP estimates for the third quarter. Guess what? 2 days later, Thursday morning, lowered it again. Tuesday by 0.2%, today by another 0.1%. They see the third quarter growing at 2% on an annualized basis. That's not it, though. Why I'm so positive? The go-to number, and I said this on Tuesday, the go-to number for GDP is the Atlanta Fed GDP Now, it's called. The Atlanta Fed, okay, that's a division of the Federal Reserve, right? It's a regional. It's a region. They came up with their model, and their model is one of the most accurate models on the street. Not only is it's accurate, they don't really have a bias other than maybe to try to make the economy look a little rosy, but there's really no true bias. I mean, they are the Federal Reserve and they're a region of it. Whereas Goldman Sachs, Merrill Lynch, JP Morgan, and the likes, they're analysts. I'm not saying they're not smart people. They're obviously very smart people. But they have a bias, let's face it. And Wall Street knows this, and anyone investing should know it. Their bias is they have clients of Goldman Sachs, client of Merrill Lynch, client of JP Morgan, clients of whatever, and they want to be as positive and bullish, as they can. They want their asset, they want their clients to keep their assets there. They want to try to make their clients happy, get their clients making money, right? So they try to put as positive spin on everything. I mean, yeah, they may have sell recommendations on certain stocks, of course, and you can make money shorting. But overall, and it's known, overall analysts put positive spins on things. And it's not just individual stocks, individual bonds. They put positive spins on the economy, and that's directly as with GDP forecast. And matter of fact, the Atlanta Fed GDP Now, not only is it one of the most accurate, it's almost always one of the most lowest numbers, at least now, because the economy's been slowing. If the economy starts to ramp up and go, it'll most likely be one of the highest, because the analysts probably won't be bullish enough, surprisingly. But anyway, so the Atlanta Fed this morning, it comes out every Thursday, about an hour and a half ago. They lowered the third quarter GDP. They cut it by 50% to 0.9% growth on an annualized basis. That's down from 1.8%, which they were expecting, and the last Thursday that actually upticked by 0.2. Now things could change next week, because tomorrow's non-farm payroll, the biggest and most important number of every month, and we know that. But as of right now, with all the past data that's come in the past week and the past several weeks, that all gets put into that calculation, a computer model. down to 0.9%. Absolutely, absolutely horrible. So, all right, so that's enough ranting and raving on the economy. So let's go to our trades. We had 4 trades, picked up 16 on a size adjusted basis. On a non-size adjusted basis, we picked up about we are normal size on 3 of them and 20%. Piece out, and you'll see what I'm talking about. On one of them, the last piece actually got stopped out at break even, so it was only like having 15%. So first one, Euro US dollar. We were short this 1.119941. Excuse me. Piece this out as well. This is the average price, 1.11738. Picked up 20.3 pips for size adjusted 4.0. We had 20% of our normal size there. New Zealand dollar, Japanese yen. We were long this 76.699. Again, we pieced this out. 76.921 was the average. Our last piece, we were actually looking for it to get taken out at 77.50. Didn't get that high overnight. Came in this morning, ended up getting out of the last piece upwards around 77.12 or so. So the whole thing picked up 22.2 pips or 6.6 pips. Solid trade there. Euro yen, we were short this 133.921. It went in our favor right off the bat. We closed a piece here about probably about 25%, I believe it was, or a third here. Held the rest. It did bounce against us. We were sleeping when all this was happening. Our stop was around just over 134.50, or I believe it was 134.52. I believe never approached that, as you could see. But before we shut the computers down for the evening, we put the rest in right pretty much somewhere where we covered the first piece, 133.81, just because we weren't going to be watching it. Unfortunately for us, it did come. I mean, fortunately for us, came down. We made money, right? So we picked up 10.7 pips or size adjusted 3.2. Unfortunately, it happened about an hour before we were in the office. I say that because if it happened an hour later, we would have been here and we would have canceled the order or changed the order and looked to piece out of it, and most likely would have captured some of this, not all of this, but could have captured some of this move by piecing out. But that's not what happened, unfortunately, and that's not the case. We'll take it anyway. Last one, US dollar, Canadian dollar. We were long this 1.34100. Again, piecing out, this was the average price that we got out, 134.301 for 20.1 pips, or size adjusted 3.0. The last piece, we got stopped out break even. So even though we had more size, getting stopped out with the last piece, it was equivalent to having about 15% of our normal size. But we'll take it. So overall, not a bad thing. 16.8 pips on size adjusted, non-size adjusted about 70 pips. So we'll take it. We'll move on. If you're still trading now, good luck. If any signals come out, they'll be coming your way. Assuming we get some action tonight and tomorrow, we'll do another video tomorrow. Tomorrow morning is non-farm payrolls, 8:30 Eastern Standard Time. It's the biggest number of every month. You know, we don't trade it. We'll look to trade after, after the market digests it, 20 minutes or so, half an hour. And preferably won't hold a position going in. If we do hold a position going in, it'll be very small as to not get hurt on it too much. So tonight, if we do any trading, if we get any signals tonight, we do some trading, it'll be on the small size, smaller than normal, just because we could be stuck in it going into the 8:30 time frame. So that's it. We're going to wrap it up. Have a great rest of your day and possibly see you tomorrow.